Good morning, everyone. Welcome to our EU-US tax update, what's new and what you need to know now. This event is organized by the European American Chamber of Commerce, New York. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC, and I will be your host for today's event. Our discussion will offer an update on major tax developments across Europe and in the United States. And our panel will address what's in the Congressional pipeline on the US side, and you will hear about legislation that is on the docket across Europe. Our panel includes Benjamin Angel. He's the Director for Direct Taxation at DG Tax at the European Commission. And Benjamin has been working for the European Commission since 1994. And he has drafted and negotiated the creation of various European sovereign firewalls. He's also directly involved in the preparation of the text establishing the European Banking Union. And he has negotiated regulation creating the European Fund for Strategic Investments, which I have to say is one of my favorite legislations in the European Union. It's absolutely brilliant. And he was part of developing the European Investment Advisory Hub and the European Investment Project Portal, which is also an incredibly innovative platform connecting projects with investors. We are also joined by Kyle Daly. He's the Managing Director at CLA Connect and our moderator. Kyle focuses on international tax needs of multinational businesses and individuals. And before CLA, Kyle spent time with the Big Four accounting firms, managing complex international business and tax projects. And he also spent over a year, helping run the daily operations and long-term vision of a biotech startup in the gene editing space. And I do hope that you have shares of that, because that is the new thing, gene editing. Last but not least, we have Mark Prater, Managing Director at Tax Policy Services at Pricewaterhouse, US, and the ultimate insider on all things tax related when it's coming out of Congress. At PricewaterhouseCoopers, Mark advises clients on tax policy issues, as well as tax legislation. And I'm told his favorite topics are tax cuts and the Jobs Act of 2017. Prior to joining Pricewaterhouse, Mark served as the Chief Tax Counsel and later Deputy Staff Director at the Republican staff at the Finance Committee. Mark was selected as a Staff Director for the Joint Select Committee of Deficit Reduction. And with that, I hand over to Kyle, who is moderating our conversation today. Kyle, over to you.
Thank you so much, Yvonne. Appreciate it, and I appreciate everyone's time here joining our pretty dynamic panel. Very esteemed, having Benjamin, from the one side of the pond, and Mark with his deep experience in policy development and leading is a very, a very timely topic, because we have had so much global tax changes over the last few years. Most recently, probably a lot of it's been tied to COVID measures, and within the U.S., we've obviously had the Tax Cuts and Jobs Act, and now we're looking at some additional stuff. But it's a really quick level set. If you had an opportunity to take a vacation, we're lucky enough, you probably would have missed some over the last week, past few months, you would have missed some pretty significant developments. And so what our goal here today is to really, get you up to speed. Kind of, we don't necessarily have a crystal ball, but kind of where things are going, or where we think things are going, and to really level set what has happened over the last 6 months, which has been critical, I think, is largely the coordinated framework at the OECD, right? That was, a significant development starting in July, and then with the G20 meetings and everything in October, where we had we have a framework and we have an agreement, and the U.S. is at that table, right? So this is a significant development, and really focusing on pillars 1 and pillars 2. So, what does pillars 1 really look at, right? Pillars 1 and that coordinated framework is really focused on the reallocation of the largest companies' profits, right? So we already have transfer pricing rules, but on top of that is a market-based approach and a reallocation of profits for the under the current framework is 20 billion of turnover. So you're looking at the Apples and Googles of the world. So it's thought to look at maybe 100 or so companies, right? The pillar two, the other leg of the two pillar system, is really then looking at that minimum tax and that 15% that was agreed to, again, and then our globe rules that was further detailed and agreed to in December, this past December. So those are the, and then the pillar two has a wider net, right? What pillar two would apply to some of those companies that are now at the 750 million, right? And that obviously casts a pretty significant event for any companies that are going into EU or wherever in the world. So, that is that's kind of where we are at from the the OECD global side, and then the US side, right? We've had we're out now at the the Build Back Better plan act is really kind of the main topic of conversation, depending on the day, right? And Mark, we'll have Mark get really into that and what's happened, and so maybe we'll start with the US side, because we've had a lot of changes and things that have happened there. And Mark, maybe provide us a little background on where we are at currently with the BBB and where you think it's going, and how that plays in with this pillar one and pillar two and the agreement that Biden was at in October.
Thank you, Kyle. Pleasure to be here this morning with Benjamin and you, and to talk through these, as you said, very timely topics for those of us in the tax policy field. Let me kind of start off, kind of put some context on where the BBB is. So, as you said, Tax Cuts and Jobs Act passed a little over 4 years ago, so it's almost 4 years in the making here. Really, the structure fundamentally derived from about 6 years of policy work, committees on the Hill, Joint Committee, Finance Committee, Ways and Means Committee, and a chairman of both parties in the Finance Committee. So it was the result of that process, and actually you can see the roots of a lot of the international provision I'll get into, even as far back as 2011. Then Chairman Camp's what was called International Tax Discussion Draft, and the Option C, which is largely what Congress ended up doing in 2017. So broadly speaking, Congress had been proceeding along this path of the traditional tax reform process, which was to bring down rates on the individual side and the corporate side and broaden the base. The US, I think, was viewed as like out of sync in terms of a pretty high headline corporate rate. There was bipartisan consensus to try to drive that down and broaden the base. And then with the election of President Trump ran on a tax cut platform. And so this tax reform process, which had largely been on a revenue neutral basis, in a bipartisan revenue neutral basis, became principally on the individual side something of a tax cut exercise as well. So those two things were going on. I will say on the business side, when you look at the international title, which actually produced revenue and did some base broadening in a traditional sense, and the business title itself, it was still per the revenue table a tax cut, but it was a permanent program and very close to revenue neutral in terms of 10-year revenue scores, in the neighborhood of 320 some odd billion, in the context of many trillions baseline. So that process largely produced a much changed system on the individual and the corporate side, and especially on the international side. So on the international side, I'm going to focus in on a little bit on that. Of course, you have GILTI, which we're all very familiar with. GILTI was really directed at outbound income. It was directed at income that was what we call supernormal return income, or income up above a normal return base. QBI in the GILTI system captures that notion, and I'll let Benjamin describe the OECD counter to that, but there is a counter to that in the OECD product and where the EU has gone with that. So that was part of it, to isolate on this supernormal return income. And on the foreign tax credit side in the GILTI regime, a lot of rough justice there. Kind of an annualized system of clipping a foreign tax credit to 80%, not allowing losses to move from year to year. Pretty significant restrictions in some ways on the foreign tax credit on a year-to-year basis. But in exchange for that, in what I would describe as a rough justice compromise, Congress, Republicans, this was processed partisanly, the Congress looked at an aggregate structure for GILTI in terms of calculating GILTI and its counterpart, FDII, with respect to complementary income, and most importantly, with respect to foreign tax credits. So there was a trade-off there in terms of how Congress approached this. And then, of course, there was the BEFIT, which was directed at some of the inbound kinds of activities and some outbound pieces, some U.S. companies as well. So that system's in effect. That was processed partisanly, even though I would say a lot of the materials, the policy materials, were drawn from 6 years of largely bipartisan activity. And I'd say there's an analog here a little bit to the ACA that was completed in a partisan way in 2010, our healthcare law. A lot of the ACA policy material was Republican ideas or bipartisan ideas. Some was more partisan, but it retained a partisan identity despite that substance, and so that affected its subsequent processing legislatively in the years after that. But it largely stayed intact and has stayed intact. So Republicans have adopted a partisan process for TCJA, Democrats adopted it for ACA. But it influenced this dynamic, this tension between the substance and the process and the politics. So Democrats win control, President Biden wins, and they decide, okay, we are going to go back in and take another look at TCJA. And what's more, we are going to use the tax system to produce revenue to fund Democratic priorities. And if you look at the House bill, well, roughly $1 trillion for out of the individual side, and roughly $1 trillion out of the corporate international side to fund priorities on the Democratic side, the new programs, etc. So different purpose, but again, revisiting the architecture, TCJA. And where did Democrats go? Well, I think it's fair to say they looked at GILTI and they decided GILTI should look more like a traditional minimum tax. So what are we going to do with that? Well, we're going to go in and we're going to do things that look at country by country for foreign tax credits. It's been a traditional priority for a lot of Democratic tax writers. They've been comfortable with that. Some, not all, but some key ones, and that raises significant revenue inside the program. They also look to mitigate some of the effects of expense allocation, which is a factor in how GILTI works and how it processes, and how it plays through the system. So they mitigated some of those effects. And they also looked at treatment of losses year over year. So they revisited, in a sense, this rough justice compromise that the Republicans had agreed to between, on the one hand, giving the aggregate structure for GILTI and treating the foreign tax credits under that system. And to the extent that there were rougher features on that, the year-to-year features, revisiting those, perhaps in many ways, to the benefit of taxpayers. At the same time, this was not done in isolation, which will lead us to Benjamin's discussion of kind of what was going on across the pond. Democrats were keenly aware of. The Treasury Department has been involved in these discussions for a long time over the Trump Treasury and into the Biden Treasury. So they were also looking to try, frankly, under the leadership of the Secretary and the assent of their two tax writing chairmen and their leadership, to try to meld somewhat or coordinate or align GILTI with where the OECD was going, and also looking at BEAT to a certain extent and trying to change BEAT to align more with the undertax payment rule. But they did preserve FDII. And interestingly enough, QBI, as I said earlier, was cut back some, but still preserved as a concept to define normal returns. Thinking back on it, this division between normal returns and supernormal returns was always a critical design issue over those 6 years. And it's not, to my surprise, not surprising that the Congress ended up going to largely a lot of the option C structure, because we would find at the staff level and in talking with members that in effect you had to define the supernormal returns by a residual method, by looking at tangible property, and of course OECD is also looking at payroll here too as a way to measure that. So where we are right now is the House has passed the bill and it has sent it to the Senate. Leader Schumer has a 50-50 Senate majority. He's got a majority because Vice President Harris, under our Constitution, breaks the ties if there's a tie vote. And so the Democrats are talking amongst themselves, trying to take the House bill and change it to make it consistent with the full Democratic caucus. And the Democratic caucus has a range of views. You have progressive senators like Chairman Sanders, and then you've got,
I think, Mark, I think Benjamin, did his freeze up a little bit for you? Okay. Well, I think we can kind of transition to you, Benjamin. I think that was Mark's, discussion, kind of really breaking that down on our policy, right? It just didn't happen overnight with Trump, right? And it's not happening. There wasn't a coincidence also that, we've implemented a minimum tax with GILTI. Now it doesn't marry up with, Pillar 2 or what you guys have done in the EU, but maybe give the audience a background on, where Pillar 1 and Pillar 2, what the rollout within the member states is going to do, some of the changes that are going to have to happen with the digital services tax, right? Some of the countries that have implemented that, and again, what is the policy? Because you've obviously been very involved with ATAD and everything else that has happened. So your international reform has been obviously happening for 5 to 10 plus years, longer than that, right? It's even since the EU came together, right? So it's always ever evolving. But what is the latest, I guess, from your perspective, and how does that policy maybe help the audience understand the policy directives from the EU get rolled out within the member states?
Many questions. Many thanks for your invitation first. Where do we stand in the European Union? Well, we have moved very quickly as regards Pillar 2. So Pillar 2 is minimum effective taxation, what is in the OECD language is called GLOBE. That is what is expected to be similar to GILTI for 137 countries around the world. The agreement was reached in October last year politically, and the model rules, that is the standard detailed description of how the agreement works, were agreed at the end of November. And the European Union has come up in a record time with a draft directive, that is draft legislation, the European Union, transposing Pillar 2. The legislative process has already started. So the European Union is the first jurisdiction in the world among all those which have approved GLOBE to start putting it in the model. The action from the European Union mirrors very closely what has been discussed in the OECD, with minor differences which are due to the specificities of our system. I will mention a couple. So the first one is that we want to make Pillar 2 binding for our member state. Pillar 2 in the OECD is not binding. It is a set of rules that the participants decide to implement or not, but if they implement it, they have to implement it the way it has been agreed. That's more or less the way it works. In the European Union, since we have a single common market between the 27 member states, having a system à la carte would be relatively messy. And for this reason, we expect all the 27 to follow the OECD rules as regards Pillar 2. The second variation, which is a little bit more substantial, is a variation in the scope. Pillar 2 normally applies only to foreign MNEs which have a turnover above 750 million euro and which are present in your jurisdiction. The way the European Union works and the way union law works, it is just impossible legally to tax more foreign companies than you would tax a domestic one. It would infringe union legislation and would lead us immediately to a major legal challenge before the European Court of Justice. And that is the reason why the transposition of Pillar 2 by the European Union does not distinguish between domestic and cross-border situation. So it does has two ramifications. It does de facto apply also to subsidiaries of domestic companies, but it also applies to groups that would be exclusively domestic without any cross-border dimension. Statistically, it should remain relatively anecdotal because it is quite unlikely that a group reaches a 750 million euro annual turnover without having any presence within another country, but we may have a couple of cases here and there. The discussion on Pillar 2 has been a difficult discussion within the European Union. You may remember that in the autumn we had a number of member states which had expressed concerns. The reason being that the agreement is an ambitious one, more ambitious than what people usually think, because everyone thinks about this rate of 15%, but what you have to keep in mind is that the agreement is around a 15% effective tax rate. And that's a big difference, because in most countries, the effective tax rate is rather significantly different from the nominal one.
Yep.
In practice, in the European Union, we had more or less 1/3 of the member state, whereas the effective tax rate is below 15%, and therefore it was an important step for our member states to agree to it, which they have committed politically, and now we are making the effort of transforming it into law. As regards Pillar 1, a lot of work is still ongoing in the OECD. There are still some major elements which are in discussion, notably a very minor question, which is where do we take the money from, which is not completely uninteresting from a political point of view. Once it is agreed, we have the intention to move very quickly to union legislation as well. This has been announced by the Commission. This union legislation will therefore be alongside the multilateral convention, which is supposed to be adopted in June if everything goes as planned. And we have announced also that we plan to use the resources coming from Pillar 1 as one of the resources of the union budget for the coming years. The calendar is very ambitious, it's very tight for both Pillar 1 and Pillar 2. The official OECD calendar is that it should start in 2023.
Yeah.
I was with Pascal Saint-Amand yesterday in a conference where he qualified this calendar as an aspirational calendar. I like the expression. I think for Pillar 2, this is doable because Pillar 2 does not call for any ratification process. For Pillar 1, it is not impossible, but it is extremely challenging because by definition, having a multilateral convention agreed in the middle of 2022, having it ratified and enter into force by 2023 in 137 countries, or at least in critical mass of them, calls for a very strong political will behind it to make it happen. So it will be challenging, but it is a priority for us, and we will do our best to make it happen. I should have mentioned, as regard our transposition of Pillar 2, something which is important for our US audience, which is we have also introduced some elements, some basic elements, as regards the equivalence between GLOBE and GILTI. We don't know all the details yet, obviously, for the reason that GILTI has not been adopted yet, but what we have put in our directive is some broad principle, which is respected, could allow to be considered GILTI equivalent to GLOBE. There's no surprise there, so we will look at the presence of a minimum effective tax rate of 15% calculated on a jurisdiction per jurisdiction basis. We have proposed in the annex to the directive a list of countries whose system is expected to be equivalent to GLOBE with only one name, the United States, which are put between brackets. And we hope that the development in the United States in the coming weeks and months will allow us, before the legislative process is completed, to take out the bracket.
Benjamin, I think that's extremely helpful and great background. And I think, in terms of that timeline, right, that I think most people would think that's pretty aggressive, but they did release the GLOBE rules right in December, and there is a pretty solid base from which to enact country and EU legislation, correct?
Well, you may call it an aggressive timeline, but we are just trying to implement the calendar which has been agreed at all levels by the 137 countries and confirmed by the G20. This calendar said it should start in 2023. For this calendar to start in 2023, and as far as the European Union is concerned, we need a directive to be adopted by May or June, so as to allow our member states to come up very quickly with their national transposition of the union law, have it adopted by their parliament, and we hope that no one is wasting time meanwhile, and that the tax administration businesses are already starting their preparation to implement Pillar 2. It is coming, it will happen, and it's a major step.
Yeah, I think one interesting, issue, or I guess maybe clarification, would be, for the companies in Pillar 2 and the minimum tax, what kind of go into that a little bit more in terms, because Ireland, it does sound like they might try to keep the 12% for companies that are below the 750, but will there be a lot of explicit carve-outs like that, or what is the kind of the mandate that could come through?
There are very few carve-out in Pillar 2. Basically, the only substantial carve-out is the maritime transport. We have substance carve-out, which were decided, where we take out 5% in the steady state of the payroll and the tangible assets from the calculation. Now you have 3 ways, de facto, to implement the agreement for country which today would have a rate below 15% effective. The first one is to increase your corporate income tax across the board and to decide from now on my corporate income tax, I don't know, will be 17, 18, 19. If you put it at 15, most likely your effective corporate income tax will still be below. So you need to be a bit more. The second possibility is to say, I do not change my corporate income tax rate in general, but I increase it only for the companies which are in scope. And this is what Ireland has decided. So Ireland will keep 12.5% for the companies which are not in scope and move to an higher rate for the companies which are in scope. Ireland did it after having checked with the Commission that it does not create any problem under our competition law, and the Irish authority have got the necessary assurances from the Commission. But you have also a third possibility, which is you don't touch your rate at all, and you just decide to implement a top-up. Each and every time the top-up should apply to the company concerned. And in the very last finalization round to the agreement, it was decided to bring a very important options, which is the option of a domestic top-up. That is, there is a possibility for the country which does not tax enough to take first the decision to tax it, rather than having the other countries capturing its tax base. We have mirrored this option in the directive, and I would expect most of the 137 countries, if not all, to make use of the option, because obviously if you don't make use of the option, you're making a present to other countries which have the possibility to tax it. So the only scenario where one could reasonably imagine that a country would not use this option is the one where it would conclude that the administrative cost of implementing it would be higher than the tax income it gets. Otherwise, it may happen, but prima facie not necessarily a very rational choice.
Yeah, and I think one other aspect, Mark, that could be interesting with what with some of these, the Pillar 1 and Pillar 2 is the interplay with treaties, right? The U.S., we've had longstanding treaties, and the treaty policy and decision making is a long and arduous process from the U.S. side, generally more so. But maybe, how that kind of plays into this and where the EU is going with that, Mark. Maybe give the audience some background on that process.
Sure. Thank you, Kyle, and apologize for the freeze up there on my internet connection. So glad to be back. So on the way U.S. Congress deals with multilateral, bilateral agreements, primarily, as you said, is through the treaty process. And in the Senate has, under the Constitution, under our Constitution, it's the Senate's role to process treaties, and there's a 2/3 vote required. There, over the last decade or so, Senator Rand Paul of Kentucky has had issues with some of these treaties and has been using his powers as a senator to hold up some of the treaties. We did get the 4 protocols through a short time ago, but there are still treaties, as we know, that are still awaiting action in the Senate. So it's a kind of a cumbersome process at times. Other times treaties can go through relatively quickly. But treaties are the primary way. There are a couple other things under U.S. law. I know there are a couple other ways it could happen. One, we have an exception to the general rules in the Senate for processing some of these agreements. For instance, in the trade area, fast track authority allows the certainty of the vote and a process for trade agreements for implementing legislation. There's also this thing called the base closing commission, which is occasional legislation that allows kind of an exception to the normal rules. But generally, to get something done in the Senate of this nature, you need consensus. You need bipartisan consensus as a matter of practicality. It's hard to. I'm not aware of a precedent where we have carried treaty provisions in reconciliation, which is the process that I mentioned briefly that the Triple B is undergoing, and TCA, of course, was done through reconciliation too. So treaty issues, reconciliation has certain limits on it under the Budget Act and the Senate rules, in terms of processing items outside of the pure fiscal space. And one thing that the tax writing committees have to be careful about is one of the limitations on reconciliation. Committees are only instructed on matter that is in their jurisdiction. They're not supposed to go outside of it. And foreign relations is the committee in the Senate that has a jurisdiction over treaty matters. So you actually saw in TCJA an instance of where the House provision, the counterpart to the BEFIT, had a specific treaty override in it, and that had to come out for Byrd rule purposes when the bill came over to the Senate. So it's very difficult to explicitly address treaty matters and reconciliation. It's just not usually. It doesn't usually conform with the Byrd rule and other restrictions. Having said all that, certainly one of the things that is important with the treaty process is conversations between the administration and the Foreign Relations Committee and the Finance Committee and leadership and other players to make sure they're on the same page in terms of what they're trying to do with say a protocol to a treaty or a new treaty or what have you. So that's a very deliberate process. You saw some of that in TCJA, where the Trump administration, State Department and Treasury were trying to put in some reservations with respect to some of the treaties the 4 treaties that are held up. So that was a conversation that needed to be taken to a different level. Having said all that, certainly under U.S. law, when you're looking at something like Article 1 and reallocation of taxing rights, things like that, you probably got to look at domestic law changes in addition to some kind of treaty or other instrument of that nature. So it's important for the dialogue to occur. So far, Republicans have, this is a partisan process. They have, you see Senator Crapo's letter of a couple of weeks ago to the secretary. You've seen other letters where Republicans have complained that they are not being consulted. They're being briefed but not consulted. So right now there's a lot of resistance on the Republican side. I do think that there needs to be some meeting of the minds on the negotiating objectives and some of the other considerations that are usually in play. So that's where we sit right now in Congress. I expect discussions will continue. We'll see. I didn't finish on BBB, but I expect that Leader Schumer is going to continue to work on that, and should he assemble the votes and it be consistent with what the House can pass, then obviously there are changes in BBB that also anticipate treaties and other things that would need to be discussed. But again, that would have to be contrary reconciliation, much more of a consensus or bipartisan process.
And Mark, we're not going to hold you to this, but I mean, it seems like in everything that's out there, you know, GILTI will be more or less on a country by country basis. You know, that the odds of that happening is quite high, because it is a decent pay for, as you were starting to go into, and you know, because that obviously would have an effect, and obviously with this more of a little bit more certainty in the EU of a 15% across the board, or for, although we do have a lot of, you know, that's a minimum tax. Would that be fair to say, Mark, that we're probably going to be looking at a 15% and on a country by country approach for GILTI?
Yeah, I think that Chairman Neal's work on the international provisions, you know, certainly the Senate will probably could change some features of those. We'll have to see. There are Republicans, as I said, did not go that direction back in TCJ. They went a different direction. So they are not there in terms of supporting it. And there are business groups and business folks that have opposed it, have raised issues with it, but you know, it's survived you know, a very narrow majority in the House, and you know, that seems the pressure on GILTI is more kind of on the timing of when it kicks in, so that the U.S. isn't really, you know, going necessarily first, that it's more in sync with where the OECD and the European Union are going in terms of the time. So there is a lot of pressure on that point. I want to be careful. There are folks, there are tax writing committee members and some businesses that are still, you know, critical of it, and academics and others. But certainly it's survived in the House, and it is in the substitute that Chairman Wyden put out for vetting for the Byrd Rule. So that's at least where we're starting, and it's a significant change, as I said, but that is the Democratic tax writers' preference, to look more at, as I said, going to a traditional minimum tax and to do the country by country and with it.
For sure. And Benjamin, you know, one of the things that I know I see a lot of U.S. companies that are looking into Europe and dealing with, you know, software businesses, or, you know, in general, all businesses, is also, we've got the VAT tax, right? That's a significant revenue driver, you know, in the EU, you know, and then you also have the digital services tax that some of these countries, you know, some of your member states have implemented, which, you know, arguably maybe provide the audience an update of where that digital service tax, you know, will they have to abandon those provisions in light of the Pillar 2, and where does the EU kind of you know, provide that fit that those separately stated, you know, separate member states digital services taxes, and then how does the VAT work within the overall EU process as well? Oh, I think you're on mute.
Two very distinct questions. So I start the easy one, which is the value-added tax, VAT. It's a tax which is harmonized at European level for a very long time. It's consumption tax basically, and it's pretty important in the tax mix of member states. If you look at the tax mix in average in the European Union, you have around 28% of the income which comes from consumption tax, primarily VAT, 52% labor taxation, and only 8% corporate income tax. So the corporate income tax is a relatively marginal source of financing for the member states of the European Union, and even this marginal source of financing experiences wide differences, since the rate range between 9% up to 35%, depending on the member states. So it's not exactly one size fits all. We have some member states with very low rate and some with a pretty high rate. Now, moving to the question of the digital service tax, this is not a question which is linked to Pillar 2. This is clearly a question which is linked to Pillar 1. The whole discussion on Pillar 1 started a few years ago now, because of worldwide perception that there is a problem with the way we tax the digital sector, which is clearly the only sector where, from any point on the planet, you can serve the whole planet without a physical presence. And tax system usually are well equipped for taxing activity where there is a physical presence, and poorly equipped for taxing activity where there is no such presence. The Commission has made a proposal for a digital services tax a few years ago. It didn't go through, but a number of member states have copied this proposal and introduced it in their own national legislation. So we have a digital service tax today in France, in Spain, in Austria, and some other countries were also considering it. Mm-hmm. What has been agreed is that Pillar 1 is an acceptable answer to the challenge of taxing the digital sector, even though its scope already goes well beyond the digital sector. And therefore, the EU member states having a DST have agreed to stop the DSTs once Pillar 1 kicks in. Not now, because Pillar 1 is still not there, but it has been agreed nevertheless that it's a bit complicated, I'm sorry, that the amount of digital service tax paid in 2022 and 2023 in excess of what would have been paid under Pillar 1 is creditable under future payment of Pillar 1. So if things go as planned, if we have an agreement globally on Pillar 1, and if this agreement goes safely through Congress, then the DST will come to an end, and we will turn this page. Should we face a different scenario, I think it's very clear that the issue would surface again.
For sure. I think that's helpful because, you know, again, a lot of, not just in the EU, right? There's other countries, I think even Canada, I know they've.
Plenty of countries around the world. You have India, you have Indonesia, you have Kenya, you have Brazil. It's a worldwide phenomenon, the DST. And it does not come out a will of being nasty with some companies, but just as an answer to a specific challenge that we have for taxing those companies. And DST is an answer to this challenge. You may think it has its flaws, like all taxes. By definition, no tax is perfect. But it helps sharing a bit the tax base. It becomes unnecessary with Pillar 1, and that's important, and that's what we should focus on. All energy now should be on making sure that the work on Pillar 1 is completed, and that all participants can ratify the convention once the convention is prepared.
You know, that's extremely helpful. I think it'll be interesting to see where, you know, some of these other countries go with this. And, you know, luckily in the EU, we'll have a little bit more certainty because you guys, the way your member states are and the union is organized with the Commission and the Congress, I think that's going to be very helpful for companies that are either investing into the EU or further their investment to have some certainty. So I guess, Mark, you know, maybe we kind of start gearing towards, you know, kind of wrapping up a little bit. But, you know, with all these changes, you know, what is kind of some words of advice in terms of companies looking to, you know, I think most companies, we all want certainty, right? You know, taxpayers, you know, as you're doing anything, you want to keep going. You know, when might we have that from a U.S. perspective? And as companies are coming from Europe and investing in the U.S., you know, some of the minimum tax, the BEAT, and other aspects, how can they kind of plan for the next, you know, 12 to 24 months. And, you know, are we going to have a little bit more certainty? I think
You're on mute, Mark.
There we go. Sorry about that. Great question, Kyle. Congress tends to act in lurches. So when you look at the calendar, look at when work periods begin and expire. And so in the next few months, there's a work period coming up. Well, there's a work period coming up after the Martin Luther King holiday recess here in Washington, and that's a pretty significant work period. There's several weeks there, and the next one is what's called President's Day recess, and then after that there's a significant work period, several weeks. Occasionally one house or the other is out for part of a week or whatever, but there is a significant period for Congress to process legislation. The president is supposed to come up to the Congress. He's been invited up on March 1st to deliver the State of the Union. The speaker is the person who invites him up, so that is very much the same party. So that is coordinated. I would be looking maybe not to the February period, but the period thereafter, because they have set up a very high-profile event. I think the president has more viewers in the State of the Union than probably any other time of year for a consistent period. So it's a very important event. So I think there will be a lot of pressure for Congress to act by then. If they don't act by then they've got the Easter recess. You know, at some point in an election year, the political energy starts to get diverted. So the sooner the better. I think Democrats are keenly aware of that. So I think for businesses, I would watch kind of what Leader Schumer is saying about the schedule. I would watch the key moderate senators, Senator Manchin and Senator Sinema. There are others behind them that aren't as vocal, but they are vocal, and watch what they're saying. I think they have some design issues they need to work out more on the tax cut side. There are some issues on the revenue side, especially the book minimum tax, which is a relatively new starter and a significant one. But it's in my almost 30 years on Capitol Hill working for the Prime Tax Writing Committee, I found it rare that, especially a one-party control Congress, would yield a reconciliation instruction that they worked so hard to get. So that, to me, is a very big factor here. And I think, frankly, as in all legislation, they need to have a discussion about the common elements where they agree, especially on the spending side of this. Child tax credit has particularly, I can tell you, many years dealing with that issue, going all the way back to 95. It always has some hard design features, and it is at the heart of where they're at a standstill right now. There are creative ways that they can get there. So I think at least, you know, the minimum tax, the excise tax on stock buybacks, the kind of structure a lot of the individual stuff. Certainly there are pieces of those that will move around, but it seems like Democrats are fairly operating on the same page on a lot of that. But, you know, look for some changes there, but probably, you know, more of the action is going to be on the spending side. So businesses, I think, should take pretty seriously Chairman Neal's design calls that he's made on the international side. Those look like they are, you know, a lot of that structure seems to have sustained itself through the process. On the corporate side, a lot of businesses are not seeing the rate increase that they thought, but they may see it in the book minimum tax. Certainly the stock excise, the stock buyback tax raises a lot of money, but again, it's a tax that's certainly businesses can plan around.
Yeah.
And some other base broadening things seem to be largely kind of played out in a sense. You've got some of the big issues have been kind of drilled through in the process. So I would look for resolution here.
Yeah.
Again, you got to get all 50. Every senator. That is a hard, big challenge. I think back 20 years ago when I was.
Yeah, I mean, they're so focused on voter reform this week, right? Or that's at least in the press, right? And that gets, sometimes different things come up, and who knows what Manchin, and where he, maybe he's just effects, right? So that could change too. So. And real quick, Benjamin, I think that's great, Mark, because again, I think that's some great advice for companies that are both coming in or going out. Benjamin, real quick, how about, I think you gave some real great feedback in terms of the timing, of 2023 of being effective, but what needs to be done in between now and then? I mean, there's a lot, right? We've got a very, very solid coordinated framework, but there is still stuff to be done. So is there pretty decent certainty for companies and what the rules might look like for them as they continue to do business or look to expand into Europe?
For Pillar 2, there is. They can see our directives. The legislative process has started, and we don't expect a high number of changes to this directive because the intention of all member states is to stay as close as possible to what has been agreed in the OECD. So anyone operating in Europe can see the directive and take it as not a 100% stable, but as a very good basis of preparation administratively. For Pillar 1, which obviously affects a smaller number of companies because Pillar 2 is for all companies having a turnover above 750 million. Pillar 1 only affects those having a turnover above 20 billion, so it's very big, and a profitability above 10%, so even a part of those which are very big. For Pillar 1, we don't have certainty yet. We just need first to finish the work within the OECD. It's challenging. The groups which are working on it within the OECD are working as quickly as possible. But as you can imagine, finding consensus on detail at 137 countries is not exactly an easy task. So for Pillar 1, companies have to be a bit patient. Obviously, we have other elements which are ongoing in the European Union and which are part of our tax agenda. We just started a legislative process on shell companies to introduce economic substance criteria concept in our legislation and measures which would help to neutralize the misuse of shell company for tax purposes. We have announced also our intention to come up in a couple of months this year, somewhere this year, with legislation addressing some of the difficulties which were identified in Pandora. And we have also a number of other legislation which are in the pipeline. We have legislation helping at getting tax information on crypto assets, which is an important area. Legislation adjusting our reaction to the debt equity bias by making it a little bit more attractive than it is today in Europe to have equity financing. Some of the text also on tax transparency. So for sure, there's a lot which is happening, and we understand that having a lot is challenging sometimes for companies just to keep the speed. There is a very widespread political appetite in Europe for having a more robust framework and for moving fast in implementing the international agreement, which is really perceived in Europe as an historic development. as a unique opportunity to reconstruct a 100-role system around better and more modern bases.
Mm-hmm.
It is complex, it is challenging, and we have to work notably on Pillar 1, but also a bit on Pillar 2 in making it a little bit more simple wherever we can. We still have on Pillar 2 to fine-tune the administrative implementation rules, for instance, to reduce the red tape for both businesses and tax administration. I think for Pillar 1, anything related to tax certainty will be key for companies, and that's an area on which discussions are still ongoing. So we need everyone to stay focused, and we need also all the good advice we can take. So we very much hope that the various business association will keep on following very closely this discussion and provide their input to help us identify possible problems along the way.
Yeah, I think that's extremely helpful, Benjamin. And I think more work to be done, right? Both sides of the Atlantic here. And I think the message, Yvonne, for the audience here is, again, keep reaching out to your political representatives, and the chamber will be active, but much more work to be done. And appreciate everyone's time today, and hopefully everyone found it helpful to get a little bit of a level set of where we're at today. And again, keep your eye on the news. It's all over, Reuters, you name it. It's on the front page of the Wall Street, you name it. It's pretty interesting time that we're all living in.
That's for sure. That's for sure. I think, tax politics is sausage making, but I think coming up with good tax policy is even more a sausage making process. But it seems to be easier in Europe. I don't know, Benjamin, if you agree with me on that or not. But
less that we have 27 country and 28 parliament, because we have the 27 national parliament and the common one. Sometimes we get the feeling.
Yeah, I think you might get off easy on this one. But like you said, there's more to come on this. As a matter of fact, we have I think I'm just looking, mid-March, we have a live event here in New York, Pan-European Tax Update. So this will address exactly the issues that Benjamin just listed. We also have on February 8th a supply chain disruption update, how to plan ahead effectively. We're doing a program on March 8th on supply chain due diligence on human rights. And on April 20th, we have a EU-US investment dialogue, very high level, president of the EIB. We are inviting Christine Lagarde, John Kerry, Timmermans. So that's going to be a really good program as well. We will have a recording of this discussion on our YouTube channel. And a quick reminder, if you're an EACC member, we are happy to connect you with any of the participants. We're all hoping to bring live events back very soon. I think it's going to be at the end of February, once we have the Omicron variant behind us. And on that note, all do please stay healthy. Don't catch Omicron. And we will see each other in a couple of weeks for our next event. Thank you so much to the panel.
Thank you,
really fantastic discussion.
Thank you all. Appreciate it.
Please note that all comments and opinions voiced by our speakers today are their own and do not necessarily represent the views of the EACC or its membership as a whole.